The year is coming to an end with fresh fears due to the worsening epidemiological situation in the world. A rebound in sentiment sparked by the easing of some restrictions in China has been replaced by anxiety about possible lockdown measures in the rest of the world. The US announced that it would require air passengers boarding flights to the United States from China to provide a negative virus test after nearly half of the passengers on the two separate flights from China to Italy tested positive. In addition, commodity markets remain under pressure from the prospect of a further monetary policy tightening by major central banks and the threat of a global recession next year. According to the trading chart, Brent crude oil futures got out of the sideways range of 84 and 85.50 by breaking through its lower boundary. As a result, the volume of short positions increased and thus dragging the asset down by about 1.5%. The benchmark will extend losses if the price fixes below $82.50. Until then, it will most likely continue moving around the broken boundary. Meanwhile, investors are awaiting the best reaction to a ban on oil and oil product supplies introduced by Russia under contracts that directly or indirectly envisage using a maximum price fixing mechanism. In many respects, this is a bureaucratic issue of a crucial importance. While uncertainty persists, no one intends to make far-reaching conclusions and take any action. The Christmas holiday also adds to uncertainty. Brussels bureaucrats are unlikely to provide any response this year. Most likely it could be due early January, so the market is expected to remain in limbo for at least a few more days. With the oil prices standing still, the situation around price restrictions and the subsequent ban on oil supplies affects the ruble somewhat directly than oil. In general, the Russian currency seems to be holding steady around 70 rubles per dollar. However, there are signs of its further weakening. If the price consolidates above the level of 73 on the daily chart, the volume of long positions of US dollar will increase. Until then, there is still a likelihood that the pair will bounce down. While Europe is still trying to assess the possible consequences of the decree banning oil and petroleum product sales to countries that have joined the price cap, the situation in Russia is the opposite. Some experts believe that there are a great number of loopholes in the decree that allow European partners to easily circumvent the ban. This is largely perceived as a weakness, thus making investors think that Russia has come to terms with the restrictions. Given the ruble's clear dependence on political factors, this continues to exert pressure on the currency. Apparently, the dollar will reverse and head towards the level of 60 rubles only closer to the mid-January. Speaking of gold, the market situation remains uncertain. Investors are awaiting the first meetings of central banks next year, hoping to get some fresh clues about the further interest rate hikes. Perhaps the regulator will announce dates for the first rate cuts, which will help the yellow metal gain upside momentum. But anyway, given that the Fed intends to keep raising its key rate until the end of spring, gold will most likely spend the first half of the next year trading under pressure. Key support levels are 1,800, 1,785 and $1,775 per 3 ounce. And that's all for now. We wish you profitable deals. See our channel with a new video in a couple of hours.